Yes, what's up everyone? Welcome to a lesson 4 in module 1. This lesson is going to be about risk management. I'm only going to be covering the basics because there is a lot more to risk management, but it would be taking me way too long to explain everything. And also I teach my clients advanced risk management techniques, and I don't want to give everything I know away for free. But this lesson will be very interesting, especially for beginners, because they usually blow up an account or two while they are learning to trade, and that's completely unnecessary, because if you learn proper risk management in the beginning, there's no need to be blowing your account. Like I said in the last video about testing, if you properly test and demo trade, there's also no need to blow accounts. But this lesson is going to be about how to manage risk, why it's important. So let's get started. First, we have the risk disclaimer. All right, so at first I will briefly explain why risk management is very, very important. And then I'm going over some basic concepts of risk management and how you can use it in your own trading, and then a bit of a recap at the end. So, why risk management is important. You've probably heard it before, but in trading, it's very, very important to protect the downside, because the more you are in a drawdown, so the bigger the size of a drawdown, the longer it takes to get out of the drawdown and the more return you have to make. So let's say you have a $100 account. It's way too small, but let's use this as an example. And you lose 10%. That means you're losing $10. Now you have $90. Let's say you make 10% on that 90. You're not back at 100. You're back at 99. So in order to get back to 100, you need to make more than 10% gain to come up to basically get break even. And the bigger the drawdown, let's say you have a 50% drawdown, so you lose from 100, you go back to 50. That's 50% drawdown. But if you want to go back from 50 to 100, you have to double your account size. And that's something to realize. So you really want to protect the downside when you're trading, and that's why risk management is important. And the next reason is maximizing profits, because if you apply risk management the correct way, you will usually lose less on your losing trades, and you will win more on your winning trades. And there are a lot of ways to do this. Like I said, I'm not going over all the exact concepts because these are quite advanced, but that's the goal. So protecting the downside and maximizing profits by either cutting your losses earlier, by being bigger in winning trades, etc. So let's go to the basics. Now, number one, know how much you risk before entering a trade. And it really surprised me how many people lack this. Before you enter a trade, you should know exactly how much you are going to risk. You should know exactly why you're in the trade. You should know exactly the odds of it working based on the past. You should know exactly where you're getting out, and you should know exactly when you're getting out, and you should know where your trade idea is wrong. And if you don't know those, then you didn't take the time to properly test your trading, and then you should go back there, because these things need to be clear before you enter trade, and this is what will minimize the risk. So most people say risk 2% per trade. Totally depends on you and the performance of the setup. So it's a good thing to start there. I'd say if you're learning and trading a small live account to test your strategy, etc., 1% is more than enough. Also in the beginning, don't vary risk, because a lot of beginners don't consistently risk the same. And then it's very hard to work out if what you're doing is working. Because let's say you take 10 trades and you win 2 trades out of 10, but you, because of luck, you risk a lot more on those winning trades and you're up money. then you think you're a great trader, but what if the luck goes away? Then you risk more on a losing trade and you lose a lot of money. Same thing, let's say you win 7 out of 10 trades and you, in terms of R, you made profit, but because you were inconsistent with risking, you actually were down money because you risk more on your losing trades. But it's hard because before you enter, you don't know if it's going to lose or not. So in the beginning, when you're when you finish your testing and you're going to trade on a live small account, try to keep risk the same. Just risk 1%, risk 2%, whatever feels right for you, and that way you can more easily learn from your mistakes and track your performance. So yeah, know where your idea is wrong. So basically, a lot of people have been taught that they need a 2-to-1, 3-to-1 when they're entering a trade. So basically get 3 when they risk 1, or risk 1 to get 3. Now they trade their risk reward ratio. They don't trade the markets, they trade the 1 to 3 because they know when they want to enter a trade, let's say a retest, and they put the stop loss X amount of pips away because they think that's the right thing to do. And then they look, okay, I want a 1 to 3, then my target should be here. And it's not based on any market structure or fundamentals or whatever. It's based on their risk reward ratio. But the market doesn't give a fuck about your risk reward ratio. And it's the same with P&L. So a lot of people risk because let's say they don't want to lose $20 on a trade, and they trade a small account, so they are not really that flexible in stop loss sizes. Then they just put in $20 of risk and put the stop loss based on the amount they risk. But your stop loss should be at the place where your idea is wrong, where your idea is invalidated, and then you use the distance of your stop to calculate your position size based on how much you're going to risk. So let's pull up MT4 for a little so I can explain it further. So let's say you want to enter at a break of this area, and you want your stop loss to be below here, and then people would be like, all right, then my target is 3R, which is over here. But it doesn't really make any sense. Maybe there's a level here, but why do you want it on 3R? Is it because it works the best? Have you tested that static targets, so 1R, 2R, 3R work better? Or is it just because you want to imply your risk reward ratio on the market? Another thing, let's say you buy this breakout. When are you wrong on the trade? You're not wrong if you're down $20 here because that's what you risk. You're wrong if there's an invalidation point. So let's say this market moves up from here, breaks out, retests, and goes up. Now then you clearly know that if this low where we're currently at breaks, your idea is wrong. But you should know that beforehand, so don't risk based on your P&L, your thoughts, your risk reward, but really look where are you wrong on the trade idea. And you should have that written down in your plan already, but that's really where you want to risk on based on. So look at where your idea is wrong, and that's where your stop loss should be, and not the other way around. So the next thing is percentage-based risk, and I spoke about it already a little bit, but percentage-based risk is, in my opinion, the best way to risk. And then there are a lot of different things you can do. You can risk according to the Kelly criterion. You can use, I don't know, smooth money ratio. I don't know what's out there. There are a lot of ways you can adjust these percentages, but a percentage-based risk basically means if you have a $10,000 account and you risk 1%, that's 100. If you have if you then win, you still risk 1%, and then you use a bit of profit from the last trade. So you're now up $10,000, $10,100, and then you basically risk 1% of that amount, and then your risk percentage is staying the same, but your the amount of money you're risking is slightly up, and that's what is creating the compounding effect, which is something you definitely want. Especially in the long run, it can really add up, and it also makes sure that once you're in a losing streak, so let's say you lose 10 times in a row, it won't be 10% exactly, but it will be less, because every trade you lose, you're risking a bit less as well. So it also protects the downside. So that's also important, percentage-based risk and risk based on performance and your personal risk tolerance. So the next thing is managing risk in an active trade, and that's also something a lot of new traders don't really pay attention to. So let's get back to 24. If you are in a trade, the amount of risk in terms of risk reward is varying. So let's say you took a short over here, you picked the exact top, congratulations. But let's say you're short here and price, no, your stop loss is at the high, your target is this, let's make this the target, which is 3R. It's a bit easier for this example, and your entry is at this. So you have a 1 to 3. Now, as soon as price hits 1R, which is, let me change the color, which is this yellow line, you're now, your risk reward in the beginning of 1 to 3, so risking 1 to make 3, is now changed, because now you're risking this amount to make this amount. So you basically are now having a 1 to 1 risk to reward ratio, and that's something a lot of beginners don't realize, and especially if the trade moves to 2R. Let's say you're 2R in profit, you're now risking 3R to make 1. So your risk reward ratio is completely turned around. And I'm not saying that you have to take action or scale out or trail your stop or anything, but this is really something to keep in mind, because sometimes people are risking an entire move just to make a few more pips, when in reality they should just be getting out. Now, don't get me wrong, I also sometimes do this, but that's because I know it's better to hold on instead of actively manage my trades and scale out or something. But I can tell you that 99% of the people don't know that. So they're just risking a lot of money for a few pips, and they don't know if it's better for them in the long run or not. So this is something to keep in mind. And let's say price moves to here, then you maybe want to trail your stop to the next high, which is, let me show you, which is above here. And then your risk reward ratio has changed, because that now price is here and you're almost back at a 1 to 1. You're now at a 1 point, you're risking 1 to make 0.75. So that way your risk reward changes during the trade. So you really want to also look at the risk you are having on during a trade, and then you can decide to maybe scale out, trail your stop, and also maybe you want to pyramid, maybe you want to add, but that's quite advanced. Don't recommend it to beginners, but I just want to explain it so that you are aware of risk during an active trade, and that you can maybe try to minimize the risk during an active trade. So these are basically the basics. This is all you need to know as a beginner to start live trading on a small account, or to start demo trading. So know how much you risk before entering, know where your idea is wrong, and risk based on your idea, not your P&L or risk reward. Risk percentage that you're comfortable with, and try to keep an eye out for the risk that you are having on during an active trade. If you aren't going to manage your trades, you really should be aware of the difference in performance between managing and not managing, and only decide to do that if you know that not managing your trade makes you more money. I also want to make a quick note, because a lot of people move to break even once they are a certain amount in profit. Don't do it, at least in the beginning, because this is just trading your P&L. Because people are up on a trade and they think, wow, I made X percentage, I don't want to lose it anymore, so if I move my stop loss to break even, I'm having a risk-free trade, not going to lose anything. First of all, that's not a risk-free trade, because you can have slippage, your stop loss cannot trigger and you still lose money, so there's no risk-free trade. And the second thing is, you're trading your P&L. It's ridiculous, because the market doesn't care about your P&L. The only reason you move your stop to break even is to not lose it anymore. Then it's not the right move to do. You only want to do that if you know it makes you more money in the long run. And if that's not the case, if you don't have the data to back it up, you don't want to be moving to break even. It's that simple. So another thing I quickly want to illustrate is, let's say people buy a breakout. So they enter here at the yellow line. Stop loss is irrelevant, but they enter at the yellow line. Now, once price moves up, maybe breaks this structure, they move the stop to break even. But markets usually retest. So price retests, and then they basically get stopped out at normal market behavior, because markets move like that. They go up, they retest, see if there's any demand, move up, and that's how market works. That's general market behavior. So you basically, because the market behaves normal, you get stopped out on a trade idea that's still valid, just because you don't want to lose anymore. And it doesn't make any sense. I had this conversation with a trader earlier this week, and he basically was in this exact same position. So I asked him, why are you selling support? And he was like, I'm not selling support, I'm long. And I said, like, look, your stop loss, his stop loss was exactly at the yellow line, and he bought at this red line to for price to go up. So I said, look, if price moves down and does something that is very, very common, which is retesting a breakout, then you're basically selling, because if you are long, your stop loss is a sell order. So you are selling your buy order back to the market at support. Why would you do that? This is the best place to be long usually, is at the retest. So why would you be selling there? And he was like, holy shit, I didn't think about that this way. And that's just really something beginners need to know. And that's also a very important thing to keep in mind. So yeah, let's get back to the slides. So to recap, I hope you learned something from this. I hope you now know the basics of risk management again. Lot more to it, but these things you've learned in this session will definitely help you to prevent you blowing your accounts, and yeah, can really help you to build a stable basis and a stable sample size of your live trading to then increase your performance. So I hope you guys learned a lot. The next session will be module 2, which is about planning. So I'm going to talk a bit more about planning, journaling as well. And then the other sessions will be a bit more about psychology, etc. So I speak to you guys in the next session.